Joining us right now with more on the impact on the markets and the economy is Nathan Sheets. He is the global chief economist at Citi. And Nathan, your sense of this deal, assuming that it gets passed, your sense of this deal in terms of what it does to rein in spending, what it does to increase defense spending.
Well, the most important feature of this deal, I would say, is what it averts, and that is the risk of a full-scale stress scenario in markets as we await some kind of further resolution of this thing, and ultimately, risk the X date. So I think that's the big news here, is that we're not going down some of those very scary, threatening paths.
I don't know that the markets ever thought we would, Nathan.
What's that?
I don't know that the markets ever thought we would. I mean, the markets have been relatively calm through all of this. I think they had the sense that there would be some deal reached.
I think that what the markets were doing is being probabilistic in nature, and you were seeing them price in some probabilities of those bad outcomes. And I think what we're seeing this morning is those risks being partially priced back out again. That's the short end of the yield curve and the treasury market, to some extent in the equities market. And I think as the week progresses and we get a better sense of exactly where the House Republicans are and some of the progressives, and a better sense of probabilities of passage, I think at that stage then we're going to see a further relief rally on this news. What it does do, and I think is notable, is that in some sense Congress is now putting down a marker and saying, yeah, we've got a fiscal problem that we're going to need to address over the medium to long run. The actual progress, though, in reducing those large deficits that are very elevated relative to history, even elevated to what we had before the pandemic, the actual progress is pretty limited. And maybe holding all else equal, we're looking at real GDP growth, maybe a couple of tenths softer than if this deal hadn't passed. But it really is small potatoes relative to the bigger challenges and shocks that the economy's absorbing at the moment.
Maybe a little bit of good news, though, just to have fiscal spending reined in a little bit when we're dealing with high inflation.
Oh, yeah, absolutely. I think it's it is the right direction. There have been some that are saying, well, there's a recession risk on down the road. Why are we tightening fiscal policy? But I think we've got to accept the reality that fiscal policy cannot be perpetually stimulative. And moving it toward, we're not even there yet, toward a more neutral stance is something that's responsible from a medium to long run perspective. And if the economy needs a little bit more support along the way, then the Federal Reserve right now is extremely contractionary and has plenty of scope to provide support if the economy slows more than is desirable to bring down inflation.
What do you think about what the Fed may or may not do at the next meeting? I ask because Steve Leisman is kind of taking a feel of the room based on what he's hearing from Fed officials, and thinks that it maybe more likely that a pause is off the table, that what we've seen recently with the data would push them to raise rates once again.
That's consistent with our view as well. We see an underlying economy that continues to have some momentum, and specifically consumer spending on services as it passes through into a tighter labor market and ongoing non-shelter services inflation. And given all that, we expect that the Fed's very likely to hike 25 basis points at this coming meeting. And for what it's worth, we see yet another 25 basis point hike on down the road, and that the Fed funds rate will ultimately peak in the mid-fives.
Which does what to your economic outlook?
Our sense is that the accumulated tightening associated with what the Federal Reserve has done, maybe coupled with a little bit of restraint from ongoing pressures in the banking system, that over, say, the next 6 months or so is likely to be sufficient to slow the labor market. We're likely to see a couple of quarters of recession. But I have to emphasize at the moment, that is a speculative call. We really have not yet seen monetary policy bite in the way that we would have expected. And we think it will, we expect it will. But the transmission of monetary policy, maybe beyond what we've seen in housing and the banking sector, has been relatively limited in terms of its impact on private spending, the restraint that it's imposed on consumption and investment.
You don't think there's a big lagged effect, a big delay where it all catches up?
You know, that's what we're waiting for. That's what I think the Fed expects, that the lagged effects of monetary policy are significant. But, you know, we're now a year plus into this hiking cycle. And even with those lags, I would have expected there to be more of an effect than what we've seen so far. But maybe we're just underestimating the lags. But it's also possible that in this economy, for various reasons, including the fact that we had a low rate period, firms and households termed out their borrowing, then monetary policy's overall effects just are not quite as powerful as what we'd expected.